Not all parts of the stock market performs the same. Just look at this matrix here. S&P 500 Value Index was the best performer last year in 2019. I don't have the end number to 2020, but I can tell you that value did not do very well this year. This chart basically shows that different parts of the stock market performs differently every year. If you go back in time and look at how the stock market performed over the last financial crisis of 2008, we can see that MSCI Emerging Market Index was the worst performer. Yet it rebounded so strongly right after that and became the best performer in 2009. Equity market performance, whether you look at them by style or geography, they're all driven by many underlying themes and economic rationale. This highlights two important things for me: the greater need for diversification, and secondly, the importance of strategic asset allocation if you really want to capture that alpha or outperformance in the market. If you, however, don't want to spend any extra time studying and analyzing trends in the market, then capturing the overall activity of the economy is your best option. This includes investing in ETF or a fund that tracks or follows global index like S&P 500 or MSCI World. However, personally, I want my investing journey to reflect some of my own thoughts and view. And while I don't take any excessive amount of risk by investing a lot of money in a single stock, I do, however, prefer to strategically allocate my money in areas where I think that active management can add value. Keep watching this video as I share with you my top 3 investing themes where I think we can strategically add value in the year 2021 and beyond. Hi guys, welcome back. I hope you're all doing well. So my first theme is Asia. I am bullish about Asian equity market. There are plenty of reasons behind why I think the Asian equity market will return superior performance over the next few years. First is the economic rationale. Chinese economy will overtake the US economy by the year 2028 due to COVID. After the COVID rebound, the US economy is expected to grow by 1.9% per year from 2022 to 2024, and then slow to 1.6% in the years to come. At the same time, IMF predicts that the Chinese economy will grow by 5.7% per year until 2025, and then slow to 4.5% in the years to come. This clearly shows how some of the emerging market economies, such as China, is going to outperform the developed market economies. There are multiple reasons behind this. COVID is clearly one. Asian economy, including China, they came out much stronger right after COVID compared to developed market economies. While the developed economies had to do multiple lockdowns due to COVID, China did just the one, and a very strict one, which meant it had less economic after effect. Outside of its expected higher growth, the second reason why I think that emerging market economies, especially Asia, will outperform the global market is to do with dollar. Dollar has been weak ever since the market started to rebound after COVID, and a weak dollar is good for emerging market economies. Over the past 20 years, when the US dollar weakened by at least 5%, emerging market equities gained 19% in dollar terms. A weak dollar allows these emerging market countries to borrow money at a much favorable term, which they then use to again improve their economic growth, translating to a better stock market performance. So, which funds can you investigate and learn more about that can capture this theme? In my ISA, I hold Baillie Gifford's Emerging Market Growth Fund. You can also look into Baillie Gifford's Pacific Fund, or if you prefer to have something with the sustainability focus, then you can look into Stewart's Asia Pacific Leaders Sustainability Fund. So this second theme, it's maybe a little controversial one. Do let me know your thoughts about it. But the market is definitely talking about this theme, and that is the comeback of value investing. By the way, if you like a quick understanding between value versus growth investing, feel free to check out my video. I'll have it linked somewhere up there, and also share the link in the description box below. So, part of the market is seriously talking about the comeback of value investing. Outperformance of value has already begun since November following the vaccine optimism. Well, the reason that market is talking about value coming back is not to do with the fact how value underperformed for last 10 years versus growth, but is to do with again some economic rationale. Firstly, let's start with the business cycle. To put it simply, value investing outperforms and tend to do better when the economy comes out of a recession, which is happening this year. 2021 is expected to be the year of recovery, and when that happens, value-related industries such as financials, energy, and materials, they tend to massively outperform the overall market. Now, you must be thinking, why does value investing outperforms during an economic recovery? Well, to answer that question, let's start from the basic. What is an economic recovery? Recovery happens when things start to get better. So we have happy people all around. We start to feel optimistic about the future. We may be getting our job back after furlough or job loss. We have more money to start spending, and that's exactly what we do. Spending money in the economy involves starting to eat out more or go for that much deserved holiday.
We're ditching our kids and taking a second honeymoon.
So what actually happens when we all start to change our behavior and start to spend money? Well, firstly, the demand for those goods and services starts to go up. And according to the theory of supply and demand, when demand goes up, so does the price. And a rising price means we have positive inflation. So inflation, or the increase in price, is something that a lot of economists are expecting to come back in 2021. And guess what? While some form of inflation is overall good for the economy, it is not so great for certain part of the stock market, especially growth stocks. Growth stocks or growth companies, they generally operate with little money currently because they're promising you a better, higher cash flow into the future. So when we have a rising inflation, what this means is that our purchasing power with our money erodes over time. And if you think about it, the same can be true and applied to future promised growth in a company's revenue or profit. Those are expected to erode much faster over time. So investors in the market, they prefer to switch back into value companies as they tend to hold higher current cash flow compared to growth companies which are promising you future higher cash flow. Now, if we shift our focus back into the economy, think about what will monetary policy do in order to curb those higher inflation. Well, monetary policy committees will simply vote to increase interest rates. And again, growth stocks, they don't perform well under rising rates scenario because higher rates makes future growth not worth so much. Because why should you pay so much and wait for an uncertain future growth when you can get a better return now? Well, this is the basic economics and rational thinking behind why some people thinks that value investing will come back. Although I am personally uncertain about whether the rotation from growth to value will continue for a longer time period, but if it does, then funds like Fidelity's Special Situations Fund is something that we can start to look into. My third theme is ESG. It was one of the emerging themes of last few years, but it really took off this year. It is one of the themes that is expected to keep getting bigger, just like passive investing did 10 years ago. So what is ESG? ESG stands for Environmental, Social, and Governance. This investing philosophy takes into account these three factors as well as financial data while making decisions about investing in a company. Investors will look into things like the carbon footprint of the company, whether they are using renewable energy, or what sort of social impact are they making in the areas that they operate in. Or for governance, they will look into their board, how diverse is the board of the company in terms of gender and ethnicity. So why am I bullish on this theme? Well, according to a research by PwC, they estimate that the market share of ESG fund can rise up to 60% in the year 2025. It is currently 15%. They have also surveyed institutional investors and found that 77% of them will stop buying non-ESG products within next 2 years. So the first word that came to my mind when I was reading that report was momentum. ESG can easily be that momentum factor over next few years. While ESG investing may be a preferred choice of investing for many investors for reasons other than capital appreciation, but if you do look at their performance, they do tend to perform better compared to non-ESG funds. AJ Bell looked into 10 years performance of non-ESG UK fund and found that they sat around 80% compared to ESG-related UK fund, which returned 103% over the same time period. There are plenty of ESG-focused ETFs and funds out there. If you want to start doing some research on ESG-related funds, you can check out Lion Trust Sustainable Future Growth Fund or Royal London's Sustainable Fund. Okay, you may be thinking that I have missed out on the biggest theme ever, which is a continuation of tech, AI, and all those good stuff. Well, the theme of tech has been going on for a very long time. Companies in this sector have tripled, if not quadrupled in size just this year. So yes, over the long term, this trend may continue, and there is a good reason for why it will continue. However, a growth number as high as we have seen this year may not be sustainable in years to come. This is the reason why I have not included it as one of the new or emerging theme of 2021. But for the sake of diversification and not losing out on any of these growth-related trends, it is also a good idea to have some allocation into this tech sector. There are plenty of tech-related ETF and funds out there. And Cathie Wood's ARK Innovation Fund has clearly been the biggest winner this year. The fund is up 170% year to date. And a few weeks ago, I've read an article by Cathie in the FT Financial Times where she wrote about 5 different platforms which will transform the global economy. In the article, she also mentioned that companies that are not aggressively investing in these 5 platforms will lose out over the coming years. The current largest holding in her fund is Tesla. So you can imagine why this fund has performed so well over this year. So while the same level of high growth may not be sustainable in the years to come by the current companies that she's investing in, but if you like her work and you think that she's capable of finding new companies to invest in for this higher growth, then looking into the ARK funds might be a good place to start. So guys, these are my personal thoughts on investing themes of 2021. And I am pretty sure that I have missed out on something very obvious. Do let me know if there's anything I should be adding to this list. That's all for today, so until next time, look after yourself and your money.